So let's just think about this. For example, you just launched your startup, okay? You got overly excited about the AI, trend that you say, hey, I got a brilliant idea. You know what? I'm going to start a AI powered company. So you bought servers, you bought, I don't know, tens of workstations, and you bought tons of testing device because it's a native app that run on users' phone. Okay, and you know what? You want to build your product. Your product may be the next big thing, but here's a catch: your company hasn't made much profit or didn't make any profit yet. So, you know what? IRS doesn't allow you to deduct more than your taxable business income of that year. Okay? Because you know what? We just discussed these limitations of Section 179, the limitation 3, business income limits. Okay? So you know what? That's the conundrum that a lot of tech startups owners actually facing. Okay? Because the business income limitation that limits you to doing this like quick deduction. Okay? So, what should you do at this moment? Don't worry, you are not just losing all the benefit yet, because there is another helper here. I'm going to introduce this big helper to you. That's the carryover rule. Okay? So basically, this is the most practical part of Section 179, and a lot of company is using it because in reality, a lot of startups do not have a lot of taxable business income in order for that deduction, so they can carry it forward. Okay, they can carry it over. So basically, this rule, the whole spirit of the carryover rule, is to protect small business and startups, especially for tech industry, because tech industry, maybe for many years they did not see the income, right? Did not see they may see the cash flow, but it may not consider the profits. Okay, there are a lot of things that happen in tech industry because everything is changed in the age of AI so quickly. So they protect all these tech small business startups from losing their deduction, especially when at the very 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 beginning when their income is pretty low. Okay, so you don't lose. A quick answer is that you don't lose all the deductions. You just have to wait. Okay? So the unused portion of your Section 179 deduction becomes a carryover. Now, basically, it means that it rolls forward indefinitely into the future until you have enough income to use it. Okay? Really, really simple. And let me just give you a form 4562. So you got the real feeling of what you're going to face it. Okay? So here, this is a typical depreciation and amortization form. And you got here the item 13, carryover of disallowed deduction 2, right? This is the form of 2024, right? 2024, okay? And you're going to carry over the disallowed deduction to 2025, okay? And there are a lot of calculation here. Add lines 9 and 10, last line 12, and it's an interconnected thing. The line 9 and have to 10 deductions, right? And the 10 is a carryover disallowed deduction from line 13. yeah. So it's a like a chain reaction. So that's the reason why I stressed a lot of times that previous year's return is very very crucial to you. Don't throw it away, okay? and bring all this information that you can, so everything can add up and make sense, so you don't lose that deduction while you are filing for this tax return. Okay, we will talk about the detailed calculation later. Right now, I just want to give you a taste of this carryover disallowed deduction and how this carryover, how's it rolling. Okay, yeah,